and welcome to the Business Standard Morning Show. I'm Nazia Iqbal. It's the 8th of June 2023 and here are the top stories for the day. India's passenger vehicle segment is facing a strange situation. While big and swanky cars are zooming out of the showrooms, the smaller ones, it seems, are piling up with wholesale dealers. Inventory levels have soared to 45 days, up from around 39 days in March. So what does it mean for the car market in India? Tushar Verma and Ayush Mishra read the roadmap.
Is it a sign of people's growing ambition with the increase in purchasing power, or is it a distress signal? Either way, entry-level cars are finding few takers, while utility vehicles are flying off the shelf. The retail sales of passenger vehicles grew by 4% year-on-year in May, but at the same time, the wholesale dealers are also seeing stocks grow heavy. Car dealers across the country reported an inventory pileup of passenger vehicles in May this year. According to the Federation of Automobile Dealers Association, or FADA, the average passenger vehicle inventory was in the range of 40 to 45 days. Compared to January 2023, when the range was 33 to 35 days, the inventory days have increased by 10 full days. Increase in inventory after a certain period is a worrying trend. Rising inventories can clog the supply chain and the dealer's ability to absorb more. So, what does this pile-up in inventory tell us about the car market?
There are three very distinct characteristics that are different from over a year ago. The monthly sale numbers have actually increased by 30%. And there are more numbers of cars that are hitting the market every month. Given the logistics and the vehicle carriers, there's a change in legislation about vehicle carriers. No new vehicle carriers can be registered. So you have them also moving by rail. So the logistics challenge. And the third is that the chip sets that are coming in, the company has to make a product depending on the chipset that they get. And therefore, you are saying different models piling up in differently.
The available statistics on an overall level is that the inventory level at the dealership in the industry would be roughly around 262,000 units. That's roughly 26-27 days of stock going by the current retail levels. On the other hand, there are some models where the production is adequate and in fact more than the demand, where the inventory level would have gone up past the 40-45 day mark.
Automobile wholesale growth in FY23 was at 26.7%. The retail growth, on the other hand, was low at 23%. The retail sales growth of passenger vehicles was 11% year-on-year in February. In March, it was 14%. It dropped to 1% in April and recouped to 4.31% year-on-year in May. The overall retail sales growth in the automotive industry was more than 10% year-on-year in May. This was driven by growth in sales of three-wheelers, which was a whopping 78.6%. According to Reuters, SUV sales in FY23 comprised more than 50% of all passenger vehicle sales. This comes at a time when overall passenger car sales were highest at 4 million units in FY23. One of the key things that hampered automotive production during the pandemic lockdown was extreme shortage of semiconductor chips. Maruti Suzuki had earlier said that uncertainties in the electronic component supplies might affect production in FY24, but the supply is easing now. On the other hand, the share of entry-level cars in FY23 PV sales fell to an abysmal 1%. Sales of small entry-level cars had peaked in 2016 to 17 when the total sales were more than 500,000 units. In FY23, it was down to mere 2.5 lakhs. Experts say this is an indication of the K-shaped recovery in India. Another indication is the fall in sales of growth of mopeds and bikes up to 100cc. Moped sales fell by 51% in second quarter of FY23 and bike sales fell by 35% in the same quarter. So, are PV sales growth led by SUVs sustainable? For how long can the premium segment carry automobile growth?
First is that during pandemic, obviously the white collar jobs were not impacted much because they were able to work from home, right, relative to blue collar jobs. But then, other big reason is the affordability has have got impacted, because if you see last 4 5 years or 3 years, Indian government has been obsessed about the regulations. The kind of regulations which have come is like being a direct hit on the entry cars, because it doesn't make any sense now to buy, pretty entry level cars, because the price gap between an entry level, a mini car and an entry level subcompact car is not much. And this is also now forcing OEMs, to actually start from subcompact segment and, limit their options or investments on entry cars. And other side is, I think the consumer is also changing, so they are also now aspirational.
Amidst growing inventory days, retail car dealers said that original equipment manufacturers should recalibrate their production lines to produce cars with less inventory days. But is that feasible?
Very much feasible that we would like to obviously produce more of the vehicles which have a long waiting period. It all depends on the availability of semiconductor components in those models. For example, in case of there is obviously the limitation in terms of assembly capacity, which is dependent on the lines at which they are produced and the factories and the plants where they are produced. For Maruti Suzuki, we have at the moment 370,000 pending bookings, large waiting periods for Ertiga, for XL6, for Brezza, for Vitara, for France, and so on. And then, of course, for models where we have been able to produce much more vehicles, there is very little waiting period.
Experts say that entry-level cars have become expensive due to government regulations, and the price gap with subcompact cars has narrowed. The OEMs too are focusing on the new mid-premium segment.
She'll soon be quoted on the front page. Business Standard.
While small cars are struggling to hit the fast lane in terms of sales, sale of two-wheelers, meanwhile, saw a good growth of 9% in May due to the wedding season and improved rural incomes. Moving on, the Education Ministry has come out with the National Institute Ranking Framework 2023, and IIT-Madras is at the top again for the 5th year running. But how does IIT-Madras continue to beat the rest? And why have the newer IITs seen a fall in their rankings? Debargya Sanyal goes searching for the winning formula needed to crack the national rankings.
3 years, from 2016 to 2018, the Indian Institute of Sciences, or IISc, reigned supreme at the annual National Higher Education Rankings brought out by the National Institute Ranking Framework, or NIFR. In 2019, this streak was broken by IIT Madras. 5 years since, no other higher education institute has come close to toppling IIT Madras from its throne. IIT Madras also bagged the first position in engineering for the 8th year in a row. IISc, which the QS World University Rankings has adjudged as the top research university globally ahead of Harvard, Princeton University, and MIT, was edged out to the second position in the overall category for the 5th consecutive year. A closer look at the score breakdown shows IISc with 83.09 marks falls behind IIT Madras with 86.69 marks on parameters such as student strength, online education, published and granted patents, and the number of economically and socially deprived students. The participating institutions are evaluated on 5 criteria: teaching, learning and resources, research and professional practice, graduation outcomes, outreach and inclusivity, and perception. IIT Madras scored 86.45 in the first criterion, 89.88 in research, 87.22 in graduation outcomes, 63.59 in outreach and inclusivity, and 100 in perception. So what has been the major factors behind IIT Madras's dominance on the ranking table?
Main reason is that we have worked as a cohesive unit. For a period of time, we had involved ourselves in 2 major initiatives. One is the Swayam initiative, where we had reached to many IITs and for course content development, and we are reaching to more than 600,000 students every semester. So this has given us a very good outreach. The second one is our IIT Madras Research Park, where we have now got a systematic way of translating our ideas to products, to startups, and also patent these ideas.
However, the Institute's golden run does not rule out its persisting challenges. IIT Madras has consistently failed to topple IISc from the pole position of the NIRF rankings for national research institutions since 2021, when this ranking category was first introduced. What then are the challenges, and how does the road ahead pan out for IIT Madras?
The main challenges that we are facing would be that to retain people in the core areas. Somebody joins civil, they have to continue in civil. And we are now seeing that there is a big drift from what they study here and what they ultimately go and work. And to address this, we are now trying to enable them to make a startup and then be part of that startup ecosystem. Basically convince these core engineering people to continue in their same engineering discipline when they go for the job market outside.
IIT Madras is, of course, not the only IIT on the list. 7 out of the top 10 ranks for the overall higher education institutions list were claimed by IITs. The IITs also continue to showcase their engineering dominance, securing 8 out of the top 10 ranks. While some of the prominent and older IITs continue to dominate the NIRF rankings, newer IITs were conspicuous by their absence in the top 10 in both the overall and engineering lists. While the IITs Roorkee and Guwahati were the only branches established after 1990 which find a place in the top 10, each of them also fell by a rank thanks to AIIMS' ascendance to the 6th position from number 9 last year. In the engineering list, IIT Hyderabad inched past the National Institute of Technology Tiruchirappalli to number 8 from 9 last year. IIT Roorkee 2 moved ahead of Kharagpur to the 5th position. Newer IITs such as Patna, Gandhinagar, Bhubaneswar, Indore and others have made it to the top 15 only in the engineering list. They fall much behind in the overall list. Team Lease's Sumit Kumar elaborates on some of the challenges facing newer IITs to come at par with the more established ones like IIT Kharagpur and Madras.
Obviously it's the older institutions. They have a huge legacy and a huge brand that they have built for themselves. Of course, it is IIT. But again, because of the legacy, because of the, their whole report card over the period of years, which has been phenomenal. And some of the newer institutions, they have to live up to the expectations, which right now they have a long way to go of, to reach that level. It's the primary reason, where they are still at the lower ranking rather than being along with the other IITs as well.
Few veteran academics told Business Standard on condition of anonymity that newer IITs are short on teaching faculty and research advisors. What's stopping young tech and management professionals from choosing the academic path into these vacant positions?
There could be two aspects. One is the aspect, obviously IT is a sector which pays well. So obviously people would have a aspiration to get into more high-paying jobs rather than getting into more academic-oriented jobs. Second thing is also, there always been a criteria that you need to be a PhD to become a faculty member of such kind of institutions, which the UGC has now kind of make it little, liberal on it, that somebody with a professional experience can also become part of the faculty. Now, that's something which the IITs also need to consider this.
PhD gives you the confidence to basically teach in a way that is more more innovative and more comprehensive, concise, and a lot of things come as a part of teaching, and that a PhD level training is necessary. And if they don't do that, then I don't think that they can teach to that level of competence. Even after PhD, strong candidates are going into research jobs in the industry, which pays them at least 6 to 7 times of what we could pay here immediately. Though our pay is sufficiently good, but I don't think that we can ever pay something close to what industry pays for such type of qualified people.
Academics agree that even as the country's premier higher education institutes continue to shine both in global and national education rankings, there seems to be a major talent crunch when it comes to teaching faculty. While government interventions are welcome, it calls for a change in the mindset among new graduates when it comes to pursuing academics as a career.
Interestingly, IIT Madras is also mulling developing a driverless car by 2025. Well then, from the country's premier institute, let's turn our gaze to the largest conglomerate. Shares of oil to telecom major Reliance Industries have underperformed benchmark indices in the past 1 year. Foreign portfolio investors too have trimmed their holdings in the stock over the past few quarters. So what has led to this steep fall in the conglomerate's shares? And will the Dalal Street's big boy reverse its downtrend? Lavisha Darat brings you a detailed report. Benchmark indices continued the upward march and gave 12% returns in the last 1 year. But investors remained lukewarm to the shares of oil to telecom major Reliance Industries during the period. Over the last 1 year, shares of Reliance Industries dipped 10% against a 12% rise in the S&P BSE Sensex during the period. So what led to this underperformance in Dalal Street's big boy? Analysts stress that the conglomerate's aggressive capital expenditure plan and rising debt levels have made investors wary of its shares.
They are coming with a lot of aggressive schemes. For example, in FMCG, they are going to have they are going to compete with HUL. HUL has started to cut prices. So HUL is also a big company. So everywhere they are getting into competition. So when you are in competition, you don't have a pricing power. Let it be telecom, still they are not getting the pricing power. Okay, here in FMCG they are going to come with soap, surf, and other products, cleaning products, where they will be competing with HUL and other companies, FMCG company. So they will not have a pricing power. They have to throw money out. And their debt levels have gone beyond a limit, which is very worrisome, because if you recollect 3-4 years back in the AGM, they said Reliance will be a zero debt company. Demerger is something the market is waiting. Once that is announced, then the stock can outperform.
In the fiscal year 2022-23, Reliance Industries' net debt nearly trebled to 1.1 trillion rupees from 34,800 crore rupees in FY22, data suggests. Meanwhile, the company's total expenses climbed 23.5% year-on-year in FY23. That apart, steady decline in holdings among foreign portfolio investors was seen in the past few quarters. FPI ownership in the conglomerate declined to 22.4% in March 2023 from 24.2% in the year-ago period, showed data. Against this backdrop, can the stock reverse its downtrend? Here's what analysts say.
As long as we see the allocation of money coming from investor side, and mark my words carefully, investor side from the global investor, the stock price will rise. If the money comes only from ETF side, then I think you can always see IRM will continue. You are basically expecting 20 to 25% CAGR over a longer period of time in this stock. So stay invested.
Meanwhile, technical charts suggest that the conglomerate can potentially rise 10% from current market price over 6 months and 22% in 1 year. Overall, analysts remain cautiously optimistic on the stock, given aggressive capex plans amid 5G rollout and expansion of retail footprint. Today on June 8th, markets will react to the Reserve Bank of India's interest rate decision, global cues, foreign flows, and crude oil prices.
He's making plans for an early retirement. Business Standard.
Moving on to our last segment, today we are decoding two interesting terms that were recently coined by world leaders. G7 countries have stressed their desire to de-risk and not decouple from the Chinese economy. But what do these two terms mean and how are they different? Tariq Ahmed explains.
Prior to meeting Chinese Premier Xi Jinping in April this year to discuss potential peacemaking in Ukraine, European Union President Ursula von der Leyen had said,
I believe it is neither viable nor in Europe's interest to decouple from China. Our relations are not black or white, and our response cannot be either. And this is why we need to focus on de-risk, not decouple.
A month later, US President Joe Biden reiterated the same words at the G7 summit in Japan's Hiroshima to explain the new trade restriction on Beijing.
We're not looking to decouple from China. We're looking to de-risk and diversify our relationship with China.
De-risking is a new term in US-European Union-China relations. The US State Department describes de-risking as the phenomena of financial institutions terminating or restricting business relationships with clients or categories of clients to avoid rather than manage risk. In regards to China, de-risking means reducing the US and Europe's dependence on the Asian giant as a market of finished goods or for imports of materials, but not entirely decoupling from it. De-risking is a part of a broader China strategy of European Union and the US to recognize shifts in China's economic and security ambitions and rebalance relationships accordingly. It includes de-risking through diplomacy, followed by economic de-risking. Economic de-risking, according to the European Union President Ursula von der Leyen, involves making own economy and industry resilient, better use of existing toolbox of trade instruments, developing new defensive tools for critical sectors like quantum computing, robotics, AI, biotech, etc., and aligning with other partners. Meanwhile, the US-China war of chips has cast a shadow on the ties between the two countries, leading to a potential technology Cold War. China has also declined a recent US request for a meeting of the two countries' defense chiefs in Singapore. It is seen as Beijing's last snub to the Biden administration amid heightened tensions. In this situation, the US is now pushing for the term de-risking instead of decouple to strike a moderate tone for its Western allies that are concerned about completely cutting off from China. The West is apparently at unease about decoupling from the world's second largest economy, as it can make access to essential goods difficult. From the Chinese perspective, the change in wording has little significance. De-risking is just decoupling in disguise, says China's Xinhua news agency. If the European Union seeks to decouple from China in the name of de-risking, it will decouple from opportunities, cooperation, stability and development, warned Chinese Foreign Minister Qin Gang at a press meet in Germany.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
External Affairs Minister S. Jaishankar last month said that it was important to de-risk the global economy while ensuring that there is very responsible growth. Well, that's all we have for you today. For more news and analysis, please log on to business-standard.com. Thank you for watching. See you tomorrow.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.